Hey everybody, we have reached chapter 20 of managerial accounting. So in this chapter, we're going to talk all about budgeting. What an exciting topic, right? Now, it really is important to budget when you have a company, and that's something we definitely want to do as managers or as owners of the company. We want to make sure that we are making lots of plans, and budgeting in general is just the process of planning future business actions and expressing them in formal plans. So we are planning out what's going to happen in the future. It's not going to be exactly like that, just like your own future. It's not going to be exactly like that, but we are trying to make a formal plan for how our financial future will look for our business. So first we want to develop a budget, and a lot of times companies will develop a budget months and months before it actually is put into place. So if you're making a budget for a fiscal year of January 1st to December 31st, you might start working on that in September or October, and what you're going to do to that is just look back at the past and see how much on average are we spending in each of these things. Do we know of any big projects coming up? And work through that to develop a budget. And if it's a big company and they have lots of departments, then it would be really common to meet with each of the department heads and say, hey, are you planning to hire any new employees? Are you planning any big projects? Because if so, we want to make sure that we work that into the budget and set ourselves up for success in the future. Then as time passes, we have to compare our actual expenses and sales to the budget. If you don't compare after when it actually happened, there was really no point in creating it in the first place. So we want to compare it, and then we want to take action to have a even better plan going forward. So if you say, oh, we actually are spending way more on employee cell phones than what we had budgeted for. So we either need to make a change to the budget and show that it's going to be more that we spend each month on employee cell phones, or we need to make a change to how many cell phones we're providing or the cell phone plan we're providing. So we want to take action in order to have the budget more accurate in the future. And then we set new plans in order to do that. So we take the action and we set plans for that. So budget timing, I already mentioned that most companies are going to use their fiscal year, so their financial year, in order to do a budget. And sometimes we'll even do a budget for quarterly, but you're especially going to want to break it down monthly. Monthly is typically how you do it, and maybe compare quarterly and annually as well. So I already mentioned that depending on the size, you may get started really early, several months before the year begins on the budget, and you may have a lot of different accountants working on it. Maybe each accountant is assigned a different department, and then it's their job to meet with that department head maybe a few times to talk to them about next year's budget, to see what changes they think we should make. And then you'll have to run that by probably the corporate controller, the chief financial officer, maybe even the chief executive officer. So a lot of steps in preparing this budget. That's why for big companies, we want to get started very far ahead of time. And a lot of companies are even using something called a rolling budget, which is kind of cool. So they're going to make a budget. Let's say it's for each quarter. It could look like this for each month. But we make the budget per quarter. And as soon as, let's say, the first quarter ends, and we're going into the second quarter, we go ahead and make the budget for the next first quarter of the following year. And if it was by month, if January ended, and now we're going into February, we would go ahead and make the budget for next January. One, it's helpful because then you're not sitting down and doing this extraordinarily long process all at once for the whole year. You're just kind of keeping it going. You're just rolling along. And two, let's say January just finished or quarter one just finished. It's all fresh on our minds. Like, oh yeah, every January we have this big bill come up, or every January we have a fluctuation in sales because of maybe it's a Martin Luther King Day special that we provide. So we weren't even remembering that before we started doing this rolling budget. But now that January just passed, we have it fresh on our minds. And the rolling budget can have those kinds of benefits. So a lot of companies are going to that. So master budget, this is where we're looking at how much do we think that we are going to make in sales. So that's a forecast. How much do we think that we will sell to customers. And then that tells us how much we need to produce. So this is going to be the trickiest part in this chapter, is doing this master budget. So how much do we think we will sell? And then assuming, again, we're a manufacturing company, we will then need to determine how much to produce. Okay, so not only do you want to be able to fill all of the orders that you expect to sell, but you also want to produce probably a little extra so that going into the next month, you'll have additional inventory already ready to go. So then when you figure out how much you need to produce, you then have to drop down and look at how much do we need to have in budgeted for direct materials, direct labor, and factory overhead. And then that can fall into some other ones that we'll cover at the end of the chapter, such as cash, selling expenses, and general administrative expenses, and even capital expenditures. So with capital expenditures, we're talking about buying, a new building, vehicles, machinery, buying a capital asset. That's something that we also, it's a fixed asset budget that we also need to consider throughout all of this. So companies need to do this whole master budget, especially for a manufacturing company, to make sure that they are budgeting the proper amount for production based on what their sales are expected to be. So we, of course, start with the sales budget. So we want to show how much we expect to sell. So doing that, again, we're going to look at the history of the company. How much do we usually sell in January, February, and so on, and look at the trends there, and then consider anything new that's going to be happening. Well, we're about to run this big campaign that we expect to really boost our sales. So if that's the case, then we would want to show that we are expecting even more sales. Or, this celebrity wore our brand, and now we're expecting that to really boost up how much we are able to sell, which means we'll have to produce more. So we estimate that in the units, the unit price and the unit sales that we're going to actually sell it for. So here we go with our sales budget. This is Toronto Sticks Company, I think. What do you think Toronto Sticks would sell? Well, it shows us here hockey sticks. So they sold 700 hockey sticks at $60 per unit in September. They prepare a sales budget for the next 3 months. So they just finished September. They sold 700 hockey sticks, $60 per unit. Even though it's Toronto, I would still think this would be a highly seasonal purchase for people. So I would think that it would fluctuate a lot throughout month to month. So here we are in October going into the winter. They have the budgeted sales in units, and they're going to give you this, but as a manager, you would have to determine this by doing a lot of different calculations and looking at the history and what you expect to be different going forward. So they're expecting to sell 1,000 units in October, 800 in November, and 1,400 in December. So maybe a lot of people are giving them as Christmas gifts, and maybe in November, they're more focused on, I don't know, not hockey, but they're expecting to sell those for $60 a piece. So we multiply it. So they're expecting to make $60,000 in sales in October, $48,000 in November, and $84,000 in December. So there's our sales budget. Again, these numbers will be given to you because they're not going to expect you to figure it out yourself, of course. So based on those sales, on how many units they're going to sell, they want to figure out how much do we need to produce. So we're going to have the units to produce will be the budgeted ending inventory. So budgeted ending inventory, how much do we still want to have when we finish October? How many hockey sticks do we want to already have manufactured going into November so that November 1st we can actually sell hockey sticks? If we have no inventory on November 1st, we have nothing to sell until we make more. Then we want to add that to the budgeted sales in units. So we look back at that slide. We think that we're going to sell 1,000 units in October. So we're going to have that many plus however many we wanted to bring over from September. For November, we're going to have the 800 plus however many we wanted to be left over from October, and so on. And then we're also going to consider that we want to subtract any finished goods that were brought into the month. So we're going to go through this together, but we have the budgeted ending inventories, what we want to be left over at the end of the month, plus the number of units that we expect to sell, minus any finished goods that were already available for sale going into the month. That tells us how many units to produce. So here's that same equation written slightly differently. So I'm going to pop it up here. Okay. So same numbers. This is our budgeted sales for each month. And they tell us in the book, they want to have 90% of our ending inventory. Let me find my calculator here. It's going to come up. So each month, here we go. Each month they want to have 90% of next month's sales already in ending inventory. So, okay, notice here, this is next month's budgeted sales. So the 800 is how much we think we will sell in November. The 1400 is how many units we think we'll sell in December. The 900 apparently is how many we think we will sell in January. And they say, look, we want to already have 90% of next month's produced and ready to go. So we take next month, so again, November, they're expecting to sell 800, multiply that times the 90%, which was just given to us. That's what the company wanted, and they told us that. That tells us in ending inventory, we want to have 720 units. Plus this month, so remember October, we expect to have sales of 1,000 units. So we want to be able to have all 1,000 of them sold, plus have 90% of next month's ready. So we want to have a total of 1,720 units ready. But they also tell us we already had 1,100 units sitting on the shelf when we started October. So we can subtract those out because we don't need to make 1,720 units if we've already got 1,010 ready. So we subtract that out, and that tells us in October, we need to produce 710 units. Then we go to November. We said next month, December, we expect to sell 1,400 hockey sticks. We want to already have 90% of those produced. So we want to already have 1,260 produced. We expect to sell another 800 in November. So when we add those together, we would need to have 2,060 ready for sale in November, already produced. But as long as everything goes as planned, we will already have 720 that we started November with. So we subtract that out to give us 1,340 units we need to produce. I'll go through December as well, just because this is kind of a confusing concept. So in January, next month, we are planning to sell 900 units. We want to go ahead and have 90% of those ready. So we have 810, 900 times 90%, 810 that's already produced for January. We add that to the 1,400 that we expect to sell in December. So we want a total of 2,210 units ready to go in December. But in a perfect world, we already started December with 1,260 units. So we subtract that out, meaning we only need to produce 950. That's a lot. So remember, October, we're going to produce 710. November, we're going to produce 1,340. December, we're going to produce 950. So we know how many we want to produce. Now we're going to follow down and we're going to figure out what our direct materials budget is. So to figure out direct materials, we want to take the budgeted production units. So we'll take that number at the bottom of the last slide times the materials required in pounds or whatever it happens to be. In this one, I think we're doing pounds of wood for the hockey sticks. So we're going to figure that out based on whatever materials that we need for each one. Then we're going to add the materials for the ending inventory, whatever we want to have in ending inventory, because they don't want to be completely out of the materials so that they start the next month and they have to buy all new materials. They don't want to do that. Instead, they want to have a budgeted amount that's still going to be sitting in ending inventory that are raw goods. And then we subtract out the ones we already had going into the month. That tells us how much we need to purchase for that month. Does it make sense? Hopefully. Okay. After this one, it's not as confusing, I don't think. So we fill in how many units that we have to produce. These top numbers came from the bottom of the slide talking about how many units we need to produce. So in October, we determined through that whole spreadsheet, through that whole calculation, that we want to produce 710 units. In November, we determined when to produce 1,340. And in December, we want to produce 950. Every unit takes a half a pound of material. So in order to have the materials to create these 710 units, we need 355 pounds of material. We also want to have, they tell us how much we want to have ready for the next month. We want to have 335 pounds left over in ending inventory. So total, we want to get 690 pounds of raw material. Then we subtract out any that we already had going into the month, and that tells us how many pounds we want to purchase. So in October, we want 512 pounds of material, and we have the price per pound is $20. So we multiply that, our financial budget is $10,240 in direct materials. In November, we figured out that we want to produce 1,340 units. We need half a pound of material to do so. So we need 670 pounds of material. We are wanting to have 237.5 pounds going into the next year. The next month, I apologize. So we're going to add that. And so we want a total of 907.5 pounds. But we're expecting to already have 335 pounds going into November. So we subtract that to say we want a total of 572.5 pounds of material times $20 a pound. We expect to spend $11,450 on direct material in November. All right. Then we look at direct labor. In order to produce everything that we wanted, our production budget, we need to consider how much labor goes into each hockey stick or each unit, whatever that may be. How much actual labor is required times how much do we pay our employees per hour on average. So we got our budgeted production times how much labor goes into it times how many hours it takes to make it. That tells us how much we financially are budgeting for direct labor. This one's simpler. We still would just pull how many units we need to produce from that first spreadsheet. They tell us that it takes 0.25 hours to produce a hockey stick. So we multiply that times how many units we want to produce. That means there will take 177.5 hours to produce these 710 units. We are paying the employees $12 per hour. So that would total $2,130 that we would expect to have to pay in direct labor. November, we expected to produce 1,340 units. It takes a quarter of an hour to produce those. So we expect to have 335 hours of direct labor times $12 on average that we pay our employees. That would give us $4,020 that we need to budget for direct labor in November. Factory overhead. We just pull those same numbers, how many units we're going to need to produce. They tell us that there is $2.50 per unit of factory overhead. That's their rate times the number of units to produce. That gives us the variable amount. Plus they tell us there is a fixed amount of $1,500 every month in factory overhead. So total, there is $3,275 that we need to budget in October for factory overhead. Told you it got a little bit easier as I went along, right? Hopefully you find that to be true. So how much is each unit based on all of these calculations? So we said direct materials, it's a half a pound of material per unit times $20 per pound. It costs $10 in direct material per unit. Direct labor, we pay them on average $12 an hour. Takes them a quarter of an hour. So we multiply 0.25 times 12, we get $3. So $3 in direct labor per unit. They told us the variable overhead per unit was $2.50. And then we know that the, this is for the quarter. Yeah, it's $1,500 a month in fixed overhead. So they're looking at this as a quarter. So for the quarter, that would be $4,500. $1,500 a month times 3 months would be $4,500 in fixed overhead for the quarter. They normally produce 3,000 units each quarter. So we divide the fixed 4,500 divided by the number of units they expect to produce, and that'd be $1.50 of fixed overhead per unit. So when we add all that together, it tells us the cost per unit is $17. How much should we charge for a hockey stick? More than $17 a piece. And there's still going to be some other cost. You're still going to have our selling expenses. So here it says they pay sales commission of 10% of the total sales. And then they also have a monthly salary of $2,000 to their sales managers. So if we have budgeted sales of $60,000 in October times 10% commission to the sales managers, they would get $6,000 plus their $2,000 salary for a total of $8,000 for the month of October. So this is not direct labor. This is for the salespeople. These aren't the people who created the product. Remember, direct labor is for the people who are hands-on creating the product. Here, that's not the case. This is for the salespeople who are going out trying to make money for the company. This one's the easiest, general and administrative expense budget. It tells us that they pay salaries of $54,000 per year, which is $4,500 a month. So there's our budget, $4,500 a month. That's all we got to do for that. They just gave us that directly. That they're not basing that off of sales. It's just this is how much our general and administrative expenses are, because this is not based off how much we produce or anything. This is, okay, these are our office employees. We pay them their salaries, maybe the rent for the office, stuff like that. Okay, the final thing we're going to talk about in this chapter is the cash budget. It is really important to know what cash you expect to come in and go out. So in order to do that, you're going to take the beginning cash balance plus any cash receipts that you're budgeting. So customers paying you minus cash payments that you're going to make. That helps us to know how much do we expect to have in cash. You know, you can have tons and tons of assets to your name or to your business's name, lots of inventory, all kinds of equipment and nice buildings. But if you don't have cash, you won't be able to pay your bills. So it's really important to have cash. So I'll do an example of this, and I believe there's also a homework video that can help you through these as well. So 40% of Toronto Sticks Company sales are for cash. The remaining 60% are credit sales that are collected in full in the month following the sale. So, whoops, wrong way. Okay. This looks overwhelming, but they tell us if this was our sales for each month, 40% of those are in cash. The other 60% is in credit. So 60%, this is how it's kind of doing it backwards here, but you can do it either way. 60% of the sales are accounts receivable or credit. They'll be collected next month. So that'll be cash coming in next month. But this month, we get 40% in cash. So they're starting with October, 60,000 in sales. 60% of that is 36,000. We're going to get that in cash in November. 40% of our sales we get in cash now, and then we get 60% of last month's because now the September customers are paying us cash. So we expect to have total cash receipts of $49,200. I'll go through it with November as well, and then we'll be done with this chapter, but you can always reach out if you need any help. So in November, we had 48,000 of sales. 60% of 48,000 is 28,800. We expect to collect that in cash in December, but this month we collect 40% of our sales. So 48,000 times 40% is 19,200. Then we collect the 36,000 from October with a total of 55,200 coming in cash in November.